Hello. So we are back with our questions. In between, I had a pause. I was doing a course, so that's why I couldn't make videos. I'm sorry for the delay. I know your exams are coming. So from today onwards, I'm going to give my 200% for AFM. It is dedicated. So my 200% of my time is dedicated just for AFM. I'll be solving past papers and the mocks and the specimen papers. Specimen papers, I think I've solved. I just have few past papers to solve and then this questions. So starting with 54, Tramont. Let us read the requirements first because requirement is the first place where you understand what is the main topic which is being examined in a particular question. Part A. If you see part A, prepare a report for the board of directors of Tramont Company that 27 and 8 marks. Okay. Evaluate whether or not Tramont Company should undertake the project to produce the XIT in Gamala and cease its production in US immediately. Okay, the question evaluate whether a project should be undertaken or not tells you something. What does it lead? It leads to a net present value. That means you have to calculate net present value. Whenever a question asks evaluate whether a project should be undertaken or not, you have to understand that they're asking you to calculate net present value. Why? Because net present value only tells you whether you will accept the project or not. So this is a net present value. Sometimes it is adjusted present value also. For that we need that particular piece of information to find adjusted present value. But in any way, even though it's adjusted present value or not, net present value has to be calculated in both the circumstances. So the project of this in Gamala is a country, and ceases production in US immediately. Okay. In the evaluation, okay, evaluation is basically pros and cons. You are saying the pros and cons and you are coming to a conclusion. So in the evaluation include all the relevant calculation in a form of a financial assessment and explain any assumptions made. Section A, 50 marks question. Assumptions will be asked. Definite it will be asked from you. There is no chance, no doubt whether it will come, whether it will not come. Should I learn? No. You have to learn means you have to learn. Okay, so they told include all relevant calculations. Now it is up to you. You have to decide what are the relevant calculations. Here they didn't specify. You have to find this, find that, find that. So that makes your work a little tough because it's very hard in that condition where to start from. Because the case study is, from top to bottom. In the top also you'll be finding some figure. In between also there are some figure. Bottom also there are some figure. Now where to start? Right? That's your question. That also will handle. Coming to the second, no, it is not over, the first part. It is suggested that the financial assessment should be based on the present value of the operating cash flow from the Gamalian project, discounted by an appropriate all equity rate. Okay. It all equity rate discounted and adjusted by the present value of all other relevant cash flows. Coming to second, discuss the potential change in government and other business factors that Tramont company should consider before making a financial decision. Now, you have to be very careful what are the elements in your report. In part A, both first and second is in your report. Part B is not in your report, okay? It is separate. So don't include part B also there. Wherever this stops, professional marks, whatever the question above that professional mark is your report. After that, they are independent questions. So this and second part is a theory question. Because in a report, you will be asked theory questions also, you will be asked calculation also. So you have to handle both. Your report is not just full of calculations in your appendix and you just have to explain. No, you have to explain some theories also. You have to state assumptions also. So this question is like the second part, which is for 8 marks. Discuss the potential change in government and other business factors. Of course, this is an international investment. So change in government is a very common question that they can ask, and also business factors. These two are very common. So 2 marks, four marks each. One is change in government and the other one is business factor that the company Tramont should consider before making a final decision. Now coming to part B. Although not mandatory for external reporting purposes, one of the members of the board of directors suggested that adopting a triple bottom line approach when monitoring the XIT investment after its implementation would provide a better assessment of how successful it has been. What is this triple bottom line? First, you have to understand what is a triple bottom. Whenever a question is asked, that specific word you have to understand. If you don't understand, it will change your interpretation of the question. So, what is this triple bottom line? Triple bottom line is your, what is it? Google and check. What is this triple bottom line? Discuss how adopting the aspects of triple bottom line reporting. You have to be very aware of this triple bottom line of reporting. You must have studied this in your SBL or in your earlier studies, management accounting or somewhere. So discuss how adopting aspects of triple bottom line may provide a better assessment of the success. This is also a question which most candidates may not be able to solve because this is a question like that, such type of a question. Coming to part C. Okay. Another member of the board of directors felt that despite Tramont having a wide range of shareholders holding well-diversified portfolios of investments, moving the production of XIT to Gamala would result in a further risk diversification benefits. Okay, so they are telling that the company has wide range of shareholders. It holds well-diversified portfolios. Okay, even then, moving their production to Gamala would result in further risk diversification benefit. What you have to do is you have to discuss whether moving the production of XIT to Gamala may result in further risk diversification for the shareholders already holding well diversified portfolios. We have solved this question in some other question, but in a different way about this well diversified portfolios. Whether if you go for more, go for more investment, can you or go for more diversification? Can you increase the benefit of risk diversification? So that also we'll discuss. Now coming to the case study. If you read this case study, if you see this is a quite a long case study. 50 marks question, 50 marks case studies are long. It could be 1 page, it could be 2 page, it could be sometimes 3 page also. 2.5 like that. You have to adapt yourself of reading such questions, retaining the main keywords, absorbing such information, remembering it when you're reading the case study also, keeping the requirements in mind and able to solve. Because there is no other way, there is no other shortcut that you can do it. All of us, whoever has passed or whoever is going to pass, have to go through this struggle. We have already when you have to go through the struggle of taking this big piece of information. Okay. One good technique, this I applied in SBL also, okay, which I learned. The moment you start reading a sentence or a paragraph, pick out the keywords or what is the main theme from that paragraph, what you understand, and write it somewhere, annotate it. That annotation will help you a lot. Let's say a paragraph. There are 5-6 paragraphs are there, okay, and one paragraph they are talking only about the financial issues, sales profit, the ratios, let's say ratios, all the type of ratios in that paragraph. So how will I annotate? I will just write ratios. That's it. I will know whatever the ratios I have to find out, I will get from this paragraph only. So I don't have to waste my time looking into other paragraphs. Annotation does that. This technique I have applied in SBL also. This technique I applied in all the other papers, whatever the papers I have passed. And it is a really great technique, especially when you have this big case studies and all to absorb. Okay. In otherwise also, even for the 25 mark question, you can do the same thing. So coming to this first paragraph, usually it is a background to the company. So Tramont is a listed company based in US and manufactures electronic devices. One of its devices The XIT is produced exclusively for the US market. Tramont is considering ceasing the production of XIT gradually over a period of 4 years because it needs the manufacturing facilities used to make the XIT for other products. Okay. Now, the government of Guatemala, a country based in Southeast Asia, is keen to develop its manufacturing industry and has offered Tramont the first right to produce XIT in Guatemala and sell it to the US market for a period of 4 years. At the end of the 4 year period, so you can understand this project is a 4 year period, okay? You need this information. What is the duration of the project to find the net present value? Okay, the full production rights will be sold at the end of the 4 year. The full production rights will be sold to a government-backed company from Guatemalan rupees 400 million after tax. This amount is not subject to inflationary increases. What is it? Okay, full production rights will be sold to a government-backed country. This amount is not subject to inflationary increases, so you don't have to inflate this. Okay, Tramont company has to decide whether to continue the production of extra in the US for the next 4 years or to move the production to Guatemala immediately. This was your requirement, whether they have to continue the production in US or move it to Guatemala immediately. Now, how can we decide that? We cannot solve this question now unless we do some calculations or do something. So currently, so basically we can see that our next few paragraphs are going to be very important paragraph. Most of the information we need there. Okay. Okay, so currently each XIT unit sold makes a unit contribution of 20. Okay. This unit contribution is not expected to be subject to any inflationary increase in the next 4 years. So it is not expected to be increased by inflation. Next year's production and sales estimated at 40,000 units will fall by 20% each year for the following 3 years. So what are you given? Production and sale 40,000 units will fall by 20% each year from the following each year for the following 3 years. Okay. Now, it is anticipated that after 4 years, the production of XIT will stop. Anticipated. Okay. Production will stop after 4 years. This you can write in your assumption. Okay. There are some assumptions which you can get from the case study itself. They have told that it is assumed like this, it is assumed like that. That itself you can take as an assumption. Because anyway, you have to state assumptions. The requirement asked also. It is expected that the financial impact of the gradual closure over the 4 years will be cost neutral. What does cost neutral means? The revenue from sale of assets will equal the closure cost. Okay, if production is stopped immediately, the excess assets would be sold for 2.3 million and the cost of closure including redundancy cost of excess labor would be 1.7 million. Now they are telling what is the cost if they stop immediately. So the excess assets would be sold for 2.3 million. Okay. So redundancy cost is 1.7 million. Okay. Cost of closure including redundancy cost of excess labor would be 1.7 million. If the production is stopped immediately, these are the costs. Now, the following information relates to the production of XIT moving to Guatemala. Guatemalan project will require an initial investment of 230 million to pay for the cost of land and buildings of 150 and machinery 80. Okay, so that 230 of initial investment is made. It is the breakup of land and buildings and machinery. Okay, 150 and it is in Guatemalan currency. Remember, everything later you have to convert into US dollar because you are based in US. Your home country is US. So it is initial investment is this. Okay. The cost of machine is tax allowable. Tax allowable depreciation will come. Either it will come in 50 marks, either it will come in the one of the 25 marks question. If depends where net present value comes. But that you have to learn. It's a must area, must topic. So the cost of machinery is tax allowable. Only machinery is tax allowable, okay, not land and buildings. And it will be depreciated on a straight line basis over the next 4 years. So it will be depreciated is easy. At the end of which it will have a negligible value. Coming to this, Tramont will also need 40 for working capital immediately. It is expected that the working capital requirement will increase in line with the annual inflation rate in Gamala. See, working capital you have to increase it by inflation. Wherever they tell inflation, you don't have to increase, you don't increase. Wherever they tell inflation, you have to increase, you have to increase. You don't assume. Okay? They will clearly tell if something needs to be increased or not. They will tell you that. If not, they will give you the inflation rate at least of each year. That sales will grow at this percent, cost will fall by this percent. They will tell that that will be given. So you don't have to worry so much about it, whether you have to increase or not. Clearly, they will tell you. So this will increase with inflation rate in Gabala when the project is sold. Of course, by the fourth year, it will be sold. The working capital will not form part of the sale price and will be released back to the Tramont. Okay, it is always released back only. That's what we assume the working capital. Coming to the production and sale of the device are expected to be 12,000 units in the first year. Okay. So production and sales 12,000 in the first year, rising to 22,000, 47,000. Okay, so first year 12, second 22, third year 47, and fourth year 60,000. The following revenue and cost apply to the first year of operation. Each unit will be sold for 70, each unit. So basically every point is here important. Okay. The variable cost per unit. Of course, you'll be given the fixed cost, variable cost, and some additional cost also, right? So the variable cost per unit comprising all locally sourced materials and labor will be this. In addition to the variable cost above, each unit will require a component bought from Tramont for 7, on which Tramont makes a $4 contribution per unit. You are given the contribution. Why you are given the contribution? You have to find the cost. You are given the sale price, you are given the contribution. Using that, you can find the cost. Total fixed cost for the first year will be 30 million. Okay, everything is in one currency, in Gamalian. So that is one good thing, that you just have to convert everything to dollar. The costs are expected to increase by, see, the costs are expected to increase by their country's respective rates of inflation, but the selling price will remain fixed at 70 per unit for the 4-year period. Selling price fixed at 70, but cost will increase their country's inflation. That means if it's in US dollar, it is given as dollar, the price, the cost. It will be inflated by that country's inflation rate. But sale price will remain at 70 only for all the 4 years. The annual corporation tax in Gamala is 20% and Chairman currently pays corporation tax at a rate of 30% per year. Okay, so tax in Gamala is 20%, Tramont pays tax at 30%. Both countries' corporation tax are payable in the year that the tax liability arises. A bilateral tax treaty exists between US and Gamala which permits offset of overseas tax against any US tax liability on overseas earnings. The US and Gamalian tax authorities allow losses to be carried forward and written off against future profits for taxation purpose. So the US and they allow losses to be carried forward and written off against future profits for the taxation purposes. Now, Tramont has decided to finance the project. Okay. It has decided to finance the project how? By borrowing the fund required in Gamala. So they are borrowing the fund in Gamala. The commercial borrowing rate is 13%, but Gamalian government has offered Tramont a 6% subsidized loan. So this looks like that adjusted present value also comes here. Because why? Because of that word subsidized loan. Okay. So the borrowing rate is 13. Okay, but they have offered 6% subsidized loan for the entire amount of the initial funds required. Now, the Gamalian government has agreed that it will not ask for the loan to be repaid as long as Tramont fulfills its contract to undertake the project for 4 years. Tramont can borrow dollar funds at an interest rate of 5%. Now, coming to there, Tramont's company's financing consists of 25 million shares currently trading at 2.4 and 40 million 7% bond trading at 1428 per thousand. Now, this is the why you are given all the shares in equity. Find the market value of equity and debt. And 40, this. You are given the bond and you are given the basically you have to find the market value of debt and market value of equity. That's why you are given all this bond and share price and value. Tramont quoted beta is 1.17. Tramont as a listed company. So of course you can find a quoted beta. So the quoted beta is this. The current risk-free rate of return is a risk-free rate is 3%. Risk market risk premium is 6%. Due to the nature of the project, it is estimated that beta applicable to the project. Okay. If it is all equity finance will be 0.4. Okay. Beta. If all equity finance will be 0.4. This word again tells you that adjusted present value is needed. See, the question didn't ask you anywhere about adjusted present value, nor they mentioned. Not even asking the requirement also. But how do you know that you have to find adjusted present value? This words, the subsidized loan, and then all equity finance. These words are used when you have to find adjusted present value. All equity finance will be 0.4 more than the current all equity finance beta financial debt beta of Tramont. Okay. So if the given project is nothing in the cost of capital applicable to the cash flow in US expected is so the cost of capital to the cash flow in US is 7%. Now coming to the exchange rate. Of course, you'll be given the exchange rate. Okay. Yeah, you have to convert also. So the spot exchange rate between dollar and yen is this. The annual inflation rate are currently 3% in US and 9% in Gambala, the inflation. And it can be assumed that this inflation rate will not change for the foreseeable future. So this is another assumption. Remember, inflation rate will not change for the future. In all net cash flows arising from the project will be remitted back to Tramont at the end of each year. All net cash flows arising from the project will be remitted back to the Tramont at the end of each year. That's why it's very important that each year you have to convert it into dollar. So there are two main political parties in Gamala. The Gamala Liberal. Now this part, this last section is given for your last requirement. Remember they asked you evaluate something about the government. Yes, discuss the potential change in government and business factors. That's why this part is there, the last part. So there are two main political parties, the Gamala Liberal Party and the Gamala Republican Party. Gamala is currently governed by the GL party, but general elections are due to be held soon. If the GR party wins the election, it promises to increase taxes of international companies operating in Gamala. Increase taxes of international companies operating in Gamala and review any commercial benefits given to this business by the previous government. And also they are going to review any commercial benefits given by previous government. Okay. Now coming to part A. Now evaluate of whether or not you have to undertake and all. Where is your starting point? Tell me that. Starting point is net present value. Of course, by now we know that we adjusted present value is needed. But first we have to find net present value. To find net present value, what is your starting point? Where do you start? With cash flow. We need cash inflow and cash outflow. Cash inflow minus cash outflow is only your net present value. We need to find a discount factor also. So cash inflow. So you start with sales. So for sales also you have to do workings. Easily you will not get sales like that. Okay, so now when I make a report, what do I write in the report? This is the format. Exactly this is the format which I have taught you. To, from, date, subject. To whom? Board of Directors of the Tramont Company. It is always to the Board of Directors of the Tramont Company only. From whom? Accountant or consultant, financial consultant, whatever it is you can write. The date which you have to write is on your exam date, whatever the date of your exam paper, you write that date. If They haven't given you any date. And subject, you have to select a subject, okay, and you have to make up a subject. So this, they have given evaluation of the proposal to reallocate production of anxiety to Gamala. You have, what do you have to do? Evaluate only whether you have to relocate there or not. Okay, so now coming to the first part, hold this part. This is your introduction. Hold it, this is your introduction. The rest all starts. Okay, so what is it? This report, or the report, considers the proposal to reallocate. What is the report about? Whether you have to relocate to Kabbalah or stay in US. So reallocate production of XIT. Mention the name of the product. If they give you a specific product, mention this. Okay, to reallocate the production of XIT from US to Kabbalah. The report includes an initial evaluation. What does initially the report do? You have to give step by step what the report is telling you. So initially, in the beginning, evaluation, and then considers the key assumptions. So first it is initial evaluation, second it is the key assumptions. Even if you have to state assumption, that also you have to write in the introduction of your report, that they are going to consider the key assumptions made in the evaluation, the potential effects of a change in government. The next is change in government of Gamala following the upcoming elections, and also other business factors. So number 4 is other business factors. Do you see how everything is included very briefly in the introduction? This is how your report should start. In your introduction, you have to say all the points which you are going to cover, but it has to be very brief. It, if you see this report, it just came up to 4 lines. But there are so many, everything is included here, that they are going to go over initial evaluation, then the key assumptions, then the change in government, the effect, and also the business factor. That should be taken into account before a decision is made. If you go to the next paragraph, they are going to talk about the net present value what they got. Exactly, that is the next paragraph. Why? The questions asked, the requirement starts with what? Whether you should accept the project or not. Okay, let me show you the requirement. If you go here, it starts evaluate whether or not they should undertake the project. Okay, so for that, all your calculation will be in appendix. If you see, only this much of paragraph is used. Only this much of paragraph. Okay, here they talked about net present value. Here they talked about APB. Do you see all the 3 lines? But to do those 3 lines, you have to do so much of working. Of course, you cannot start writing net present value now, or you cannot talk anything about adjusted present value, because you have to do your calculations. So after your introduction, leave 1 page or 2 page depending on the length of your report. If you feel that it needs 1 whole page, of course it needs more than 1 page, because a report will never come to 1 page. It will always be around 2 to 3 pages. So leave 2 to 3 pages and go at the end and then start doing your appendix. That is a very useful this thing. Okay, or you can even write stating few of your assumptions if you feel so, or you can write your assumptions at the end only after doing all the calculations. I prefer doing all the calculations in one go, finish it, and then complete and fill up your report. That is the most effective way according to me. But if you want, you can do it, fill the report wherever you can. Like some assumptions you can write later, you can with calculations, maybe you can write some other assumption, that also you can do. But with that thing is, there's a confusion. You will forget what you wrote. Okay, you have a very high tendency to forget what you wrote earlier, so you might repeat the points again later. But again, it's your choice, your paper. So if you go through the report, you can see the next is assumptions. In the report, you have to write subheading for each requirement you are supposed to do. If you see, maybe there are just two assumptions, so 2 paragraph. Then garment change is another separate subheading. After that, other business factor is also another subheading. Okay, and then finally the conclusion. So this should be a report. For each, you have to leave space. Now let's directly move towards appendix, because without appendix, without our calculations, if I explain you the report or start reading the report, will not make any sense to you. Okay, now the first thing is net present value of a Gamalian project. What do you have to do? Take a ruler, start drawing, make up a table, 5 columns, six columns actually. One is for the year, your description. The other one is starting with year zero. It should always start with year zero. It's 4 year, but yes, don't forget about year zero. So year zero, 1, 2, 3, 4. Okay, take a ruler. Be professional. Maybe I think March is the last paper where you are going to go for paper based. So if it's a computer based, then you don't have to do so much of working. All this making of table is not needed because you'll be doing your workings in the Excel. So everything is there inbuilt. You just have to fit in the number. That's it. So that's going to be one good thing when it comes to computer based. But for now, since March is a paper based, you have to take a ruler, draw the proper lines. Without ruler, don't draw lines freehand. Looks very, very unprofessional. And first thing, go and write currency. What currency it is? Currency is very important whenever it's an international net present value. And most of the time, if you see, it is always international net present value only you are given. Because through that, they want to cover everything. They want to cover exchange rate also. They want to cover your net present value also. They want to cover your adjusted present value also. They want to cover everything. So domestic net present value rarely, but it is mostly international net present value only. They want to go and invest overseas in some project. Most of the questions are like this only. That's why you're given inflation rate. You are sometimes you have to predict the exchange rate using that inflation rate. So everything is there. They are asked everything. Okay, all the syllabus they are touching from that one question. So next, since this is the international net present value, currency is very important. So writing currency, they are dropping down the three zeros. As you can see, that's why the three zeros and also GR. Very important. I have underlined in every year you have to put, not just in 1 year, not just in year zero and then not writing in 1, 2, 3, 4. Coming to sales revenue, always sales revenue is only your first thing. And if you see it is working too, that means what? Even though this is in your appendix, your working has to be away separate. It has to be in a separate place. Make sure another one thing I want to note, I want to tell you here is don't start doing workings under appendix first. First, in your see your display, the way you present is also very important. What you present first, what you present at the end, it's very important. That order is very important. So you cannot mess around with that order. So first, as soon as you write appendix, this table has to be there. Full table where net present value is shown. Wherever you cannot find a figure, write it as working. Keep 1 or 2 page, or depends on your judgment how much space you need, because I cannot tell, right? Sometimes you need 1 page, sometimes you need even more also. So here looking at this, it looks like that it needs more page. So leave the according spaces and then go to the next page, start doing your working. For what? For sales, only sales. And then whatever the value you get, go and put in that table. Come to the next variable cost. Again for that variable cost, go to the working, do the working, come to the table and write it. So this should be your way, order of doing. Coming to the sales revenue. Let's go to working 2. If you see it is in working 2, that means what is working 1? Working 1 is exchange rate. Even though working 1 is exchange rate, we are not using exchange rate immediately. We will be using it later because we need it. We need the exchange rate, right? So that's why they are keeping it ready. Okay, you can even start working with your sales revenue also first. But then the price 70 is in dollar. Remember, the 70 exchange rate, if you see selling price, where was it? Yes, 70 per unit. That selling price is in dollar. You have to find in Gamalion first. For that to find in Gamalion, without exchange rate, you cannot do. That's why they have first found exchange rate. So that's why that is working 1, exchange rate. So now we are going to go by exchange rate. How are we going to do? What is the exchange rate now? The exchange rate is given as 55, which is in year 0 now. Using that exchange rate every year, you will continue for year 4. Now, how are you going to calculate? You are given the exchange rate. for year 0 now, and you are given the two inflation rate. You are given the inflation rate of the two countries. So can't you find, if you are given the inflation rate of the two countries and the spot exchange rate, you can predict the exchange rate for the other 4 years. That is known as purchasing power parity, PPP, if you know, where you are using the inflation rate of the two countries to predict exchange rates. So you have to use inflation rate. 1.09 divided by 1.03. How do you know which one comes up, which inflation rate comes up and which one goes down? Which country's inflation should be in the numerator and which one should be in the denominator? Let us go 55, right? Look at the price. It is 55 GR per dollar. So the GR inflation should come up and the dollar should go down. So Gemala, if you see the inflation is 9%, US is 3%. So it will be, if you see, it will be 1.09 exactly. Divide by 1.03. Gemala's inflation will be on the top because 55 is in Gemala. Divided by the dollar's inflation rate 1.03, 58.2. Now if you see from here, they are taking it and they are predicting for second year. It will be same inflation only in all the 4 years, and then you are getting all the rates. Now second working number 2. See how they are showing the working number 1, they are putting a name for that working number 2, they are putting a name. Always put a name for that. What is that working? Just don't put some number and start doing any calculation. Some of you do most of the calculations you calculate and just put the main answer in your work. So what is the use of the working? There is no working in that. If you have to use your calculator, you have to show that it's not that you're writing, it should not be like this. Let's let's say in this. Okay, this is for your understanding purpose. I'm showing you what mistake a candidate could do so that they can lose marks. Now let's say now is 55. Now 55 into 1.09 divided by 1.03. This whole thing you have performed in calculator. You didn't show it here. You just wrote 58.2. You just wrote 61.59. You just see, because the calculation you did in calculator. You think you will get marks even though it is correct? Do you think you will get marks? You will lose the mark for your working which you didn't show. Maybe for that answer, yes, but you will not get the full marking. You will not get the full mark. You have to show this. You have to show this. It's very important. Then you have to write it and then you have to perform in your calculator and get the answer. It's not that it's not the other way around. That you work in your calculator and then just write the answer like this. And write it in the working. Otherwise, what's the use of putting this in the working? In the main table only you can put it. So that working, please show step by step. It will not take so much of time. Coming to the sales revenue. Write the formula for the sales revenue. Second working. Revenue is equals to price into units into exchange rate. Write this. It will save a lot of your time. It will not cost you. Later when you have to check whether you went wrong somewhere or not, it will be very easy for you to check. Why? Because you know. Price has to be there, unit has to be there, exchange rate has to be there. If all the three are there, your answer is correct. You can actually see whether the exchange rate which you have picked is correct or not. Whether the price for the each year you have picked is correct or not. Whether the units you have picked for each year is correct or not. Okay. So since the selling price is $70, so it's not going to change for all the 4 years, 70 only. Here also, this is very important. Drop into the 3 zeros. You can even work with the 3 zeros also. Then you don't have to write this on the top. If you are including the number as it is, writing all the 3 zeros at the end. Like in millions you are dealing. Sales. What is the sales unit? 12,000, 22, 47, 60. It is given. An exchange rate you have to use. Don't go and put 55 here. Because 55 is in the first order. If you see the order, that table, 55 is in the first one. Don't go and put 55, then 58.2. Check the year. Very important. Under which way you are putting number. This is year 1. This is year 0. This is the very common mistake which most of you do. That's why I'm informing again and again. I'm showing you this mistake. Check the year exchange rate. Year 1 has to go for year 1. 58.2, 61.59, 65.18, 68.98. And then you get. So this amount already will go to your main table. Shall I now go and check sales revenue? Now coming to the variable cost, local, working 3. Okay, so working 3 is your variable cost. Each working has a number in that order only, the way they have done the calculation only, that order. It is following that order, and also the name is given. If you see here, this table, they could have given working 4 for sales revenue and working 1. Maybe you must have found variable cost first or sales revenue first. But usually you should not do this because it will cause a lot of confusion. Follow that order. It's much easier because you know from the beginning whatever you have done, you can just tick it off. You're starting with your table with sales revenue. So you have to start working with sales revenue. If you find variable cost first and then you go to find sales revenue, you're wasting time. Whereas you can find sales revenue, put it that in the table, main table, and just go to the variable and start working. So order is very important for your time management, to save time. You should know what you have to do first and you should know what you have to do next. The most important thing you have to do in the beginning, the least you have to do at the end. It cannot be the other way around. So that timing, that sequence, at what sequence you put each working is very important. This is what I'm trying to teach you. Every question I repeat. So coming to the sales revenue. Sales revenue is also units into inflation after year 1. Cost will increase by inflation. So what is it? What is the unit? The units are same whatever you have taken for sales revenue. 12, 22, 47 and 60. Okay. For year 1, there will be no inflation. Inflation from year 2, 3, 4, it will keep on. And if you see, it is 135, the unit cost. Okay, we'll check 1350. Here also, it is in 1000. Everywhere, if you have put in one place, right? Everywhere you have to put this. Don't forget. So we'll see, because I kind of forgot, because by the time you come now to variable cost, you will forget. You have read this requirement way before. In between you did so much of calculation, so it's always better to return to your case study and check. It is not, the case study is not given for you to read once only and then start doing all your, no, every time you have, wherever you forget something, keep back referring to that case study and find for that what is this cost. Check again. Don't assume that I have read this somewhere, it is like this. There is no harm in checking again. Check again, confirm that it's correct. Variable cost is correct, variable units are correct, the inflation rate is correct. So variable cost, okay, it is 1350 here, second bullet point, and it will increase by that country. So Gamaliel's inflation is 9%. Okay, so if you go to working 3, first year you don't have to do anything, you just multiply by 1350, and second year 1.09, then 1.092, then 1.09 to the power 3. So this will go to your table above. Now coming to working 4. Working 4 is what? Okay, so imported component working 4. All these are deduction, they are cash outflows. Imported component. Just see the number and just refer to the table. It's in same order only. The way you are doing the working, in that way only you are putting that in your main table. So for imported component, price into unit, into inflation after year 1, into exchange rate. You have to use inflation exchange rate here. Basically, you have to see the currency. Wherever it is in dollar, you have to multiply by inflation rate. Wherever it is in Gamaliel currency, forget about inflation. There you don't have to use exchange rate. Everywhere you don't have to use exchange rate. Wherever it is needed, you have to use it. So now, what is it? It was $7. The price is 7. For all the 4 years, it is 7. Unit, same unit, whatever you have used for variable cost and sales. Inflation, it is in US dollar, 7. So in US, the inflation is 3%. That's why, not in the first year, from second year onwards. So 1.03, 1.03 to the power 2, 1.03 to the power 3. Then you have to multiply by exchange rate. First year, second year, third year, fourth year. Okay, so this amount will go to the main table. Just see here. Now coming to the fixed cost, inflating at 9%. There is no working for the fixed cost. You just have to inflate it by 9%. Okay, so so right now, okay, I forgot what is the fixed cost. So now I will go and see what is the fixed cost again to confirm. So fixed cost is 30, yes, in the first year, and it will increase by the inflation because all cost will increase. So from the table itself, you can inflate it by 9%. You don't have to do a separate working for that. Wherever inflation is there, old inflation is there. So the 30,000 you inflated by 9%, and then 32,700 inflated by 9%. Every year you keep inflating by 9%. Then the amount which you get is profit before tax, and then for that, after that, tax. After that, tax. Working 5. Separate working for tax. Tax always requires some working. Okay. So let's go to working 5. Taxation. If you see, it's a huge working, right? Usually taxation is not so big. It's very small amount. Not much working is needed. But sometimes it is in this question. Now, profit before tax. Of course, you have to take profit before tax. So profit before tax, you can just take from the table as it is. If you see in the first year, it is a loss. And then rest all it is. So we are taking profit before tax. The reason why we are doing a separate working for the taxes, all these workings, we cannot do in the main table. But this tax has a lot of working because remember, we have been told that losses can be carried forward and be set off against the profit in the future year. That's why this table is needed for taxation separately. Tax allowable depreciation. Tax allowable depreciation is a straight line basis over the 4 years for the cost of machinery. What is the cost of machinery? I forgot. So I will look the table, the requirement, right? So if you see, it is machinery is 80 million, right? 80 million will be divided by 4 years. So it will be 20 million each year, right? So that's why it is 20, 20, 20, 20. It is in million only here also. If you see, they're dropping down the 3 zeros. So 20,000 means 20 million. That's how you have to read it. You're writing it as 20,000, but you're reading it as 20 million. Okay, now coming to the revised profit or loss. So this tax allowable depreciation you have to deduct from your profit because that is the purpose of tax allowable depreciation, to reduce your tax. To reduce your tax means from profit before tax, this has to be deducted. So when you deduct your revised profit, negative for the first year, second year old is 7, and then profit for the third and fourth year. Now coming to offset against previous losses, you have to offset against previous losses. What is it? That means for year 1, whatever the loss is there, can you adjust it? You cannot. It is loss, so it will be 0 only. You cannot offset in year 1. It is loss. So out of that, okay, now one thing, remember one thing, tax allowable depreciation you have to deduct, but if you see year 1, it is added with profit before tax. Why? Because first year it is loss. So loss, and if you have to deduct something, that loss is in negative. So negative minus something will give you a bigger negative number. Okay, you can do it in your calculator and check. When you put in your calculator, don't put 2201 minus 20,000. You will get a wrong answer. You have to put minus 2201 minus 20,000. Then you will get minus 22,201. You have to be very smart with your calculator what number you are putting. Exactly, if it is negative, you have to put minus in your calculator, minus number. Minus something. You cannot put a positive number and then say that I'm getting a different answer. You will get a different answer. So it is minus 2201 minus 20,000. It is still subtraction only, but this time the number is minus. That's why you are getting a bigger number. So it is 22,201. That is the loss. So offset will be 0 in year 1. Coming to year 2. Okay, that 22,201 has to be offset against future profit. So second year you are already having 7 profit. That means that 7 will be fully offset for the previous losses. 7 will go. Now what is left? So 22,201 from that 7 is offset in 201. How much it will be offset in the third year? From 22201 minus 7. 22,194. This whole thing can be set off in year 3 because we have huge amount of profit. So nothing, no losses will be carried forward in year 3. Okay. Here it will be this much. Okay. Here it will be 0. So tax base for both year 1 and 2 will be 0. 3 and 4 it is we have, and then comes your tax is at 20% because in Gamalion the tax is 20%. Okay, we'll check again but whether it is 20 or 30 because we have been given two different taxes for two different country. Yes, it is 20% in Gamalion and US 30%. Okay, so the tax is 20%. So if you take tax at 20%, deduct that tax from the tax base. So this only will go as a tax. This. Since it is tax, it will be deduction only. You have to deduct this from here, the main table. So if you see here, it is 0, and this and this. Now, after tax comes your investment. Okay. What is your investment? Land and building plus their machinery, which is 230,000. So 230,000 is your investment. Out of that 230,000, you can see 450,000 in the fourth year. Why that why this 450,000 in the fourth year? From where? From where that 450,000 is coming? Here. Government rupee 450 million after tax. This amount is not subject to inflation increases. Okay, so at the end of the 4-year period, the full production rights will be sold to a government-backed company for Government rupees 450 million after tax. That's why after fourth year, it will be sold. So you're receiving that much of cash, 450. That's why that 450 million it is. So 450,000 you're getting in the fourth year. That's why it's an it's an inflow. Okay, now coming to the working capital. Working capital is what? 40 million. 40 million. About that, there is some assumptions about working capital. Let's see that. So they will need GR 40 billion working capital immediately. It is expected that working capital requirement will increase in line with annual inflation rate in Gamala. So what is the annual inflation rate in Gamala? It is 9%. Okay, so when you have to find 9% of 40,000, you will get 3,600 in year 1. That's how you are getting first year annual working capital. For the second year, how are you getting? For the second year, when you have to add your year 0 and year 1 working capital because working capital is increasing every year by inflation. That means when you're going for the second year, it will be 40,000 plus 3,600, 43,600 into 9% On this you have to find 9%, which will be 3924. When you're coming for the third year, this 3924 also has to be added with your previous working capital on that 9%. So like that, every year you have to put, but when you come for the last year, final year, what you have to do, just add all. Just add all. Whatever you get is this. It will be positive because it will be recovered. Okay, just add all your working capital from year 0 to 3. 0, 1, 2, 3. Whatever the total amount will be recovered, which will add up to 51801. Now, total cash flow. What cash flow? Which currency is cash flow? Gamelin. Once you get Gamelin cash flow, do we have the discount rate of Gamelin to discount it? We don't have. We only have the discount factor of what? Of US. So you have to convert to US first. You have to convert to dollar first. Do we have the exchange rate? We have the exchange rate of all the 5 years to convert to dollar. So just put the exchange rate there, 55 from working one. From working one. Okay. Now after you put, now what is the cash flow? The dollar cash flow. Okay, so you just have to divide. Let's say for year 0, it will be 270 million divided by 55, which will be 4909. 4.909 million, right? So you just have to divide the exchange rate by the total, the Gamelin currency cash flow. Now the discount factor, for the discount factor is working 6. Discount factor is not given. For that separate you have to do work. Working 6. Why separate working for this thing? Because we have to find not WACC, cost of equity. If you are telling WACC, you are not thorough with your theory part. What does theory says? When you are doing adjusted present value, you have to assume net present value as if all equity financed. As if all equity financed means cost of equity you have to use as a discount factor. So cost of equity we have to find out. It is not as given. It is not given. But how? But we can find cost of equity. How? We have the asset beta. We can find the equity beta and then cost of equity. So that cost of equity we are going to use to discount the cash flow. Right? Now, to find that equity beta, asset beta, we need the market value of equity, market value of debt. We need cost of equity. Okay. We need equity beta, asset beta. So all those things we need. So now, what are we doing? What is the equity beta? Equity beta is 1.17. I kind of forgot. We'll go and revise it back. Equity beta, when you are coming to equity beta, you just have to follow this one 1.17. Quoted beta means equity beta, not asset beta. 1.17. You are given the risk free rate, market risk premium, that is for your CAPM, your capital asset pricing model, that is given. Now let us go to your equity beta. So beta applicable to project if all equity finance will be 0.4, more than the current all equity financed beta. All equity finance beta means they are talking about asset beta, 0.4. So now, but first we have to find the market value of equity and market value of debt also, right? We can do that also. So market value of equity, how we are going to find? We have been told that 25 million shares and at 2.4. So just multiply and 60 million, and market value of debt 40 into this was the price 1428 per thousand means divide by 1000. So this is the market value of debt. Now asset beta, assume debt risk is free. Now what is the asset beta? So equity beta into value of market value of equity divided by market value of equity plus market value of debt is your asset beta. So this is into 0.7. Why? Because 30% you have to pay tax. In US, 30% is the tax, not 20%. Don't take Gamelin's tax rate here. So 1 minus 30%, that's why 70%. After tax you have to take. So this is 0.7. That is the asset beta, project's asset beta. So they told that the asset beta is 0.4. Okay, we'll read this again, once again. Okay. Due to the nature of the project, it is estimated that beta applicable to the project, if it is all equity finance, will be 0.4 more than the current all equity financed beta of Tramont company. So it will be, you have to add a 0.4 with that to get. So we are coming to that. 0.4 plus that 0.7, what you got? This is the asset beta. This is the asset beta. Check. Check this and this. In any condition, your asset beta should always be less than equity beta. If, let's say, your asset beta is 1.18, you are wrong somewhere. Error. Because it cannot exceed your equity beta. Now, 1.1 is the equity beta. So that 1.1 you multiply by 6 risk premium and add with risk free rate, and 9.6 round up to 10%. Whenever there is some cost of equity or cost of capital or WACC, it is 9.6%, 9.7% or something like that, you can round up. You can use that round up figure, to the whole number. Let's say in this case it is 10%. Okay. But first you need to write the exact number, that it is 9.6 and say 10% you are using. Okay. Don't write 1.1 into 6 plus 3 is 10% only. That shows that you have made a arithmetical mistakes. Now coming to parts. Okay, before going to that, this discount factor is 10%. That means using that 10%, now we'll discount all this cash flow, the dollar cash flow, and we find the present value. And if you find the net present value, it is this much. Now you have to write. Don't drop down the last 3 zeros. When you're writing answer like this, net present value, you have to write it the whole number. If it's in million, write all the zeros. Okay, so it is, if you read this, it will be 1.9 million, 1.921 million. Now, so net present value we are done. Hereafter, whatever the working we are doing is for adjusted present value. Net present value part is done. Net present value, base case net present value. Here also, dropping down the 3 zeros, but the currency is dollar. Okay. From here onwards, you don't have to worry about converting this to that, because it will be in dollar. You only have to worry about changing into dollar from Gamelin is in your net present value part, not in your adjusted present value part. So now coming to base case net present value. What is it? 1921. Additional US tax, opportunity cost, and additional component contribution. Okay. Which will be in working 7. Then we have the closure revenues and the cost. What is the revenue and what is the cost of the closing? And tax shield and subsidy benefit. Of course, tax shield and subsidy benefit will be there in a adjusted present value. And finally, we get the adjusted present value. So closure revenue and cost. Okay. What is it? So here they have told excess assets would be sold for 2.3. So this 2.3 and the labor, excess labor would be cost. So that 2.3 minus 1.7. Okay, that's 600. Where is it? So that's 600 is there. Coming to working 7 and working 8. You have to be very careful in working 7 and 8, because these are the areas where you can easily go wrong. Okay, so since this is an area where we are not so much exposed to net present value, yes, we always do net present value, but adjusted present value rarely, not all the time. So you need little more of practice in this area, exposure in this area, because in even in AFM, even in financial management, you're not so much exposed to it. This is a new area, adjusted present value. So net present value you have been calculating from your F9 stage. So you're very familiar, you know how to do all those things. That's why I'm focusing more on adjusted present value. Additional tax, additional contribution opportunity cost here also in dollars 3,000, 1, 2, 3, 4. No need to worry about year zero here, okay? It is only for your net present value. Here you can start from 1. So additional tax which you have to pay in US. Of course, the first two it will be zero only. 59 and 137. If you see there's a star mark. Why? How they have got that 59 and 137? They are showing that. Okay. So the taxable profit divided by exchange rate, because Gamalian currency you have to first convert into dollar and then you have to multiply it by 10%. Why? Why is it? Why is it? Why is it so? Why additional tax comes into the picture? The reason why is in Gamalian the tax was 20% and in US the tax is 30%. So you have already paid 20% tax, but in US you have to pay 10% tax. The additional 10% tax you have to pay. They will not charge the full 30% tax because of double tax treaty. That additional 10% they will charge in US. That's why. That's why the 10% is charged. So taxable profit divided by exchange rate come into 3 and 4. For that we again have to go up, right? Where is it? So here it is 7694. So let's check. Okay, if you see the tax, okay, it is 59 and 137 additional tax. Taxable profit divided by exchange rate. So taxable profit of what? Taxable profit in Gamal and divided by exchange rate you have to take. What is the taxable profit? Okay. So how do you do that? how are you getting the taxable profit? You just have to focus on 3 and 4, the third year and the fourth year. I'm taking a little time here so that you can observe that. I don't want to rush through. You can take your own time. You can even go through the tax. Third year and the fourth year. Okay. So it is very simple. You just have to take your tax base and divide that by the appropriate exchange rate. So here it is 60, go up 65.18, and here it is 68.98, and multiply it by 0.1 because tax 10%. So here you will get 59, and here you will get 137, right? 59 and 137, round up. It is rounded up. The reason why is that tax base is in Gamalian. If you see this currency, that you need to first convert into dollar and take 10%. That's why you are dividing it by the exchange rate. So now you see, coming to the opportunity cost, two stars are there. What does it? How do you get the opportunity cost? Don't worry. I know I'm not able to finish. I didn't even finish half of this, right? But part two is also coming for this. There'll be part two of this. So opportunity cost. What is opportunity cost? Go to the double unit into contribution into 1 minus the tax rate. Of course, after tax you have to take. So unit into the contribution. You're losing it. You're losing on this. What is the unit and what is the contribution? And if you see the third one, additional contribution. So unit into contribution into inflation into 1 minus tax rate. Okay. So first we'll work out on the unit into contribution into the tax rate. Tax rate is of course 30%, right? Unit into contribution. So here it is. Each unit sold makes a unit contribution of 20. This unit contribution is not expected to be subject to any inflation increase in the next 4 years. Next year's production and sales estimated to be 40,000 units will fall by 20,000 each year for the following 3 years. Okay. So 40,000 into 20, which is 800,000. And on this you have to take 70% because after tax is 30%. So after tax it will be 70% you have to take. So it will be 40 into 20 into 70%, which will be 560,000. And this 40,000 units will fall by 20% each year for the following 3 years. So if you see here, they are going to lose 560. This is in thousands, okay? It is already told that it is in thousand. Next, how you are getting it? So they told it will reduce by 20% the units. It will reduce by 20,000. Now it is 40,000. So 40,000 you deduct by 20,000. 20% it will reduce, means you take 80% of this. On that you have to take multiply it by 20 because the unit, the contribution per unit, and then multiply this by the after tax, which is 70%, because tax is 30%, which you will be getting 448,000. Coming to the third year, again you have to deduct this by further 80%. Again you have to take 80% on that. So it will be 40 into 80%, again into 80%, because it will keep reducing by 20%, and into 20 is the selling price, into 70%. Third year when you go, everything will remain same, just again take 80% because it will keep reducing. Okay, so on 358 you just have to multiply 80%, it will be 286.4 but 287. Additional contribution. What is the additional contribution? How are you going to get the additional contribution? It is unit into contribution into inflation 1 minus tax rate. See, the key always is to get for the first year. When you're studying, when you get for 1 year, rest all is solved. Rest all will fall into place. Once you get the first step correct, for the first year you know the working, how to do. Rest all falls into the place. Why are we doing all this additional tax, opportunity cost, additional contribution? Because you want to find what is the total present value. If you are not doing in US, you want to seize in US, you want to find what is the net present value of it. That's why we are doing this additional tax. Why additional tax? Because if you switch to Gamala, you have to pay additional tax in US for that profit. Opportunity cost, you are going to lose in US. You are going to Gamala, so you are going to lose whatever you are going to have, contribution you are going to make. Additional contribution you are going to make. The total cash flow, 7% the discount factor. The 7% is already in US, the discount factor. And then the present value. If you see that present value, it is in negative. Rest all you will be able to get. The thing is additional contribution. How do you get that additional contribution? Okay, let me show you why it is 7%. Yes, the cost of capital applicable to cash flows in US is expected to be 7%. That's the reason you're using that 7%. Okay, next, that additional contribution, how are we getting it? So the formula you see here, it is unit into contribution into inflation into 1 minus tax rate. Right? It is 34. How are we getting 34? Just get for 1 year, rest all you will get it. Let's find out. Here, in addition to the variable cost above, each unit will require a component bought from this one on which they make a $4 contribution per unit. So they are making a contribution of 4 from that component, Tramont. So we are going to take this 4 contribution per unit, right? So for the first year, it will be 4 multiplied by 40 into the inflation, which is 3% in US, into 1 minus tax rate, which will be tax rate 70, so 30. Okay. It's coming up to 3360. No, something is wrong. Something is wrong here. Something definitely is wrong. The additional contribution, it's 4. And the contribution which they are losing, it is so opportunity cost additional contribution. So you also find, and let me also find out this. I wasn't prepared for this question, so this part specially. So let us do this together. Yeah. So let us read this again. Which they make a $4 contribution per unit. Something is wrong. Something is not going. Let us do today. Today we'll find out this together. Okay? You also sit with a paper and a pencil and find out. because the number, if you see, it is very small number. Okay, how do you solve this type of questions, especially where no, it's very hard to find. It's not a closed number, it's a very small number. The additional contribution is just 34. If you try to put the same units into contribution and just take that inflation, the 3%, right? If you put 560 into 3%, you will not get 34. You're not getting 34. Okay, when you're not getting some answer in one way, okay, you have to think think out another way of doing it. Okay, don't just get stuck in that one way. If it's not working in one way, try other way, try every possible way. This is when you're learning. Of course, in the exam you won't have so much of time to do all this, but when you're learning, this is also one way of learning, right? We are learning only. When you're stuck somewhere, one thing is not working, don't break your head. That means it will not work. Definitely it will not work. Try other way until you don't get a way out. Okay, so now we are struggling in this. We are struggled. So we need a solution to come out of this. So how are we getting that? It has to be in the dollar, right? So let us go again to the case study. I'm sorry, I've wasted so much of time in between. Again, I'm saying sorry and sorry once again. But you can just forward those part and see when we get the solution. So each unit sold. Now we are going to go to this paragraph and read it. Currently, each X unit sold makes a unit contribution of 20. Currently, what they are making. So this unit contribution is not expected to any inflation increase in the next 4 years. Next year's production and sales estimated 40,000 will fall by 20% each year. That's why you keep on multiplying by 80%. It is anticipated that after 4 years, the production will stop. It is accepted the financial except of the gradual over the 4 years will be cost neutral. Revenue of sales will be equal to closure cost. Okay. So the following rest all is applicable after you go to Gamela. It is not needed for this purpose, if you see. All this is for your, what is it for? When you go to Gamala, it is not for your US purpose. So here, I don't need so much because since I have used all this information, so it's very clear that this all information does not apply. Okay. So I know that my information which I need is from this paragraph only. First, second, third paragraph. The third paragraph. And maybe that 4 contribution per unit. because that extra contribution, that 4. Okay. So we'll try. We'll keep on trying. 4 into 12 to 0.03 into 0.7. We are getting 1008, which is wrong. Okay, so the numbers which I'm getting is 2, 4 digit and 3 digit. I'm not even getting a number close to 2 digit. Okay, that means I have to, what should I do? I should change my, okay. But it is somewhere in this area only. First, when you're working, you have to be very sure that even if you're getting wrong, what is the area that you need to target on? But I know that this is the area. These are the paragraphs which I need. What are the additional contribution I can make? So maybe we can get from here. We'll see. So we'll try to deduct the, no way I'm getting it. So we'll try this in the part 2 and I will come with part 2 when I get the solution. Okay. But don't forget to watch part 2 because part 2 is equally very important. I'm going to finish this whole question in part 2. We are going to go for part B and we are going to complete the whole report.